Welcome to Alternative Investing. I'm Mark Bunting, along with my co-host, as always, David Kaufman, president of Westcourt Capital. This is the show where we shift our focus away from stocks and bonds to explore investment concepts that help you break away from the pack and potentially capitalize on some big gains. This week, we'll be looking at real estate investing, including the different classes of investments, as well as various real estate investment styles. Now, David, let's start with the broad strokes here. What are the benefits for investors to invest in real estate?
There's really 5 benefits to investing in real estate that are commonly regarded. The first is diversifying out of the public markets, which is really achieved through the lower correlation that both public and private real estate assets can have compared to the broader markets as a whole. Then we move on to the very important capital preservation. That's what most people, of course, seek, is at first, let's not lose money before we try and make money. Then, of course, everybody wants consistent yield. We'll be talking about this later in the show, where there's this thirst for yield across the board. But at the same time, people would also like to have some capital appreciation in their portfolio, some growth, and real estate investing does allow for that. And finally, one of the most important parts of all is that real estate provides an excellent hedge against inflation.
What are the main classes of real estate investing? There's
4 main classes, and there's really 2 that mirror image each other. So first we have public equity real estate investing, the most common form of which is a REIT, which of course all Canadians would be familiar with. An example would be Boardwalk or RioCan that
right.
we hear about every day. And that is equity real estate investing, so buying actual buildings, whether they be residential or office, industrial, commercial, and then operating them, and then grabbing the income from there and paying it out to investors. Then we get to public debt real estate, which is publicly traded securities that trade in the debt, the mortgages that are attached to the real estate that we talked about on the equity side. And then the mirror image of that is that you get the private equity real estate, which looks the same, except that these are not publicly traded securities. So you could have a private REIT, for example, which does the same thing that a public REIT does, except that it's not publicly traded, which might have lower volatility, but at the same time comes along with less liquidity. And then you get private debt real estate, which is, again, the private mortgage market. And we've talked quite a bit on this show about that. And you can go anywhere from giving your neighbor a mortgage all the way to investing in, for example, a mortgage investment corporation or a MIC, which does the same thing that a REIT does, but instead of pooling investors' capital and buying real estate assets on the equity side, they pool investors' assets and then they provide mortgages, often to the very people who are putting the equity together for fund holders in that description.
So those are the main classes. What are the different types of investing styles in real estate?
There's 3 main styles, and you can often get a hybrid. The first is core, and core would be, an example, you go and buy a fully rented plaza. So you buy it at whatever cap rate that you can get, which means whatever yield that you can get out of it. It's already fully rented, and essentially that's sort of a milk the cow approach, where you don't have to add a lot of value to it. You just have to hope that the checks don't balance at the end of every month, and you're good to go. Then you get the value-added approach, and an example there would be that you might buy a partially rented apartment building that's a bit of a fixer-upper. So you already have some income that's coming in, so that it's got a core component to it, but that you do certain value-added activities, new lobby, new elevators, so that you can A, increase the rents, and B, you can decrease the vacancies in order to have capital appreciation along the way. And then finally, we get the most risky, but with the highest reward, which is opportunistic investing, which would be, for example, distressed office space in Calgary, where you would buy a building that is not well leased, and then you would have to apply the value-added techniques and then move it up so that eventually it might become more of a core type of opportunity, but that it would begin as a growth opportunity, which would be cheap when you buy it.
And lastly, David, there are risks in every kind of investing, risks in real estate investing. What are they?
The biggest risk associated with real estate investing, especially private real estate investing, is the illiquidity. If you were to buy an apartment building or an office building, it would be wholly illiquid in the sense that you couldn't just sell it tomorrow for market prices. And that illiquidity is less so, for example, in a REIT, as we mentioned, but is still there. And the way to overcome that is either to buy publicly traded real estate securities, which we've already discussed, which would give you instant liquidity, and the other would be to diversify and go through funds, which, although they hold illiquid assets, are well diversified and have a little more liquidity than the assets themselves.
All right, a great primer as always. We'll take a quick break here. Coming up, we'll chat with our guest about how to find the best yield for your real estate investment. Welcome back to Alternative Investing. I'm here with my co-host David Kaufman, president of Westcourt Capital. Now, this week we're discussing real estate investing, and it's time to bring in our professional, Corrado Russo, portfolio manager with TIMBERCREEK Global Real Estate Fund. Nice to see you.
Nice to be here.
Now, you've got quite a background in real estate. Give us a sense of what you've done and where you've been.
Sure. Well, I've been investing in real estate or general equities for the last 15 years. About a third of that has been spent doing real estate directly or buying commercial office buildings and retail shopping centers for Ontario Teachers Pension Plan Board. The next 5 years of my career was more on the public equity space, predominantly managing portfolios for a large Canadian mutual fund as well as an insurance company, focused mainly on high-yielding products, so income trust, preferred shares, convertible debentures, that sort of thing. And the last 5 years has really been focused on managing global real estate securities portfolios, again on behalf of large institutions around the world.
At the top of the show, we talked about the thirst for yield. Some people talk about that people are addicted to yield. Can you explain how it is that real estate generally and some of the funds specifically that you've dealt with can serve to satisfy that thirst?
Sure, absolutely. I mean, yield is really what real estate's about. Real estate is about having long-term leases and collecting a cash flow every month from the tenant base and using that cash flow to essentially pay out to the owners of that real estate and collect that yield. So that's traditionally what real estate's really been about. The fund that I manage targets a 7% dividend yield, and that's really the focal point of what we're trying to deliver to our clients. The thirst for yield has really given real estate a lot more attention over the last few years. Obviously, with interest rates being as low as they are, investors need to find other ways to create that income stream, and real estate really does provide that. And I think more so, not only does it give you the income, but it gives you income in a way that actually gives you protection against inflation as well, because the underlying cash flow streams do grow with the pace of inflation over time.
But do you think that the focus on yield has worked in some cases to investors' detriment, where they have overlooked the opportunistic kind of investments that have enormous growth possibilities?
Yeah, absolutely. You've got to go into any investment with a total return approach. If you are getting a high current yield today, there could be a reason that you're getting that high current yield. It could be either that there is no growth potential, so today's yield is all you're going to get. It could be that there is a higher risk profile to that cash flow stream, and that's why you need a higher cost of capital going in. There are examples out there where you're getting a low yield, but you're getting a low yield because the potential for growth is much greater, the quality of that cash flow stream is much greater, and therefore you're willing to accept lower yields. So you really have to look at the holistic approach to investing in real estate.
Now, Corrado, aside from yield, do you think it's essential for an investor to have real estate somewhere in their portfolio?
Absolutely. My view is that real estate is a core portfolio or core holding in any portfolio. It does give you a lot more benefit than just yield. First off, in terms of total return that I've talked about, it has performed. The total return of real estate has actually beaten out general equities and fixed income over the long term. If you look at the last 30 years, the returns on public equities, which is the easiest to measure, has performed close to 12% on an annualized basis, and that's been better than many of the other asset
classes. We're looking at that here against the S&P 500 and some other real estate categories.
Yeah, exactly. And so as you can see on the board, it has performed over time. So it's had great performance. But, it's not only yield, it's total return. It gives you the diversification against other asset classes. So it does have low correlation to general equities and fixed income. So you do get that de-risking of the overall portfolio as you add real estate as a core holding. You also get the inflation hedge as the cash flows do keep pace with inflation over the long term. And again, of course, you get the attractive going in income from real estate as well.
Of course, one reason that income is possible to achieve is the use of leverage in a portfolio. And I'm interested in what do you consider to be an acceptable level of leverage heading into a real estate investment, or that you might see in a fund as a whole?
Generally, we like to see leverage in the 40 to 60% range, but it really depends on the type of real estate. If you're looking at a sector that has very stable cash flow streams, say like regional malls, very long-term leases, 10-year leases to high credit tenant, that's a very stable cash flow stream. You're able to take on longer terms or higher ratios of leverage. If you're investing in an asset class that is more cyclical, like hotels, where you're going to go through the ups and downs, you do have to maintain lower levels of leverage to protect against the downturn and to make sure that you have liquidity throughout the entire cycle.
Now, of course, the current conditions in which we find ourselves might prove otherwise, but there is a cost to leverage, and a lot of people watching at home right now have the cheapest leverage that they'll ever see when it comes, for example, to the mortgage on their own home or any kind of investment property they have. But I know that a lot of people are very concerned when they're thinking about investing in real estate, especially because there's such a high levered component to it. What will happen when interest rates go up? Because I don't think they're going down. So what will happen when interest rates go up?
Sure. I mean, typically when we think about interest rates rising, the cost of capital rises, we all panic about falling prices. But you really have to look through that and understand, why are interest rates going up? And if interest rates are going up to offset inflation, well, inflation's coming back because of economic growth. And if you're seeing economic growth, that means that rents are rising, occupancies are rising, the negotiating power of landlords versus tenants is rising, which all translates into rising cash flows for the real estate investments that you have. So, even though interest rates are rising, your cash flow is offsetting the value of that. What you ideally want to do, if you're looking at real estate opportunities and how a rising interest rate environment or the perception of rising interest rates will impact new investment opportunities, is you want to buy real estate investments where the lease duration is short, so that you're able to constantly renew your leases at the new market rents and keep pace with inflation. But you want to have your debt longer duration. So in times like today, where you're getting very positive leverage and attractive leverage, you want to be going out long term, locking in 7, 10, 15-year debt as long as you can. Even if you're paying a bit more today, you're securing your expense for the next 10 or 15 years.
So at the end of that year, I can jack up the rents, but my cost of capital will be the same.
Exactly.
Okay.
Now, David talked off the top about the different styles of investing in real estate, different classes. To you, what do you think the best method is for somebody to get into the market?
Well, it's interesting. David touched on all of the 4 sort of major areas of investing or ways to invest in real estate. And I think the ideal thing is really to have a bit of everything. You really want an investment vehicle that can invest across that capital stack. And that gives you the ability to find opportunities in those different areas. Each of those 4 quadrants, if I can call them that, have different advantages and disadvantages. Public equities do give you growth over time and great capital appreciation, but they also give you more volatility. And then with the more volatility, you also get liquidity. So there's advantages and disadvantages. On the private side, you get less volatility. You're not marked to market every day with the general markets, but you also don't have any liquidity if you need to get out. On the debt side, you get a very stable return, but you are susceptible to a rising interest rate environment, and you don't get that inflation hedge. If you're investing in equities, you do get that inflation protection over time as your cash flows grow with the underlying inflation.
And just quickly here, is this a good time to invest in real estate, do you think?
Well, I think the first thing I'd say is, if you're buying the right assets in the right markets, it's always the right time to invest. Having said that, if we look at today as a snapshot, real estate really is still on sale around the world. And if you look at where we've come through the financial crisis, real estate in many markets around the world are still trading at 30 to 40% below peak levels. In terms of how we value companies, we're seeing 15 to 20% discounts to the underlying intrinsic value of the collection of assets that they own. So in our view, when you put those kinds of returns on top of the 7% dividend yields that you're getting, those are some pretty attractive numbers.
All right, Corrado, very good. We'll take a break and come back with David and Corrado. More on real estate investing after this.
Canada's leading experts on alternative investing. He is the president of Westcourt Capital, a registered exempt market dealer.
Welcome back to Alternative Investing. I'm Mark Bunting, along with David Kaufman from Westcourt Capital. Our guest is Corrado Russo from TIMBERCREEK Global Real Estate Fund. And we're talking real estate, obviously, and you've been giving us a lot of insight. Now, I understand that you look at and invest in real estate outside of North America a lot of the time, as opposed to in North America. Why is that?
Oh, there's a few reasons, but I think it all boils down to quality and choice that I have outside of North America, as well as a risk return. To explain further, if you look at the choice, obviously, if you have the entire world to choose from, you have the much greater ability to find real estate that's inefficiently priced. And if you can find inefficiently priced real estate, you're going to get outsized returns. So, the bigger the market, obviously, the better. In terms of quality, I think that's an important issue. It's not that there are not great assets available here in Canada. There are great assets. The problem is they've all been bought up already by the pension funds and larger institutions here in Canada. That's not the case when you go outside of Canada. Much of the best real estate in the major markets around the world are still held by public companies, and there's still a lot of transactions that happen on a year-over-year basis. So the ability to access quality real estate is a lot more plentiful. In terms of risk return, we talked about real estate as being a relatively low correlation to other asset classes like equity and debt. But if you look within real estate, actually the local markets around the world have low correlation to one another. And that's really because unlike other asset classes or other sectors within equities, real estate still is a local market, and it's driven by the local demand-supply fundamentals in those markets. So because of the low correlation, we're able to go outside of our domestic market to chase higher returns without having to increase the overall risk of the portfolio.
So in order to discover what's undervalued out there, you've racked up a lot of frequent flyer miles. So now that you're back with us, you can tell us what markets right now are undervalued, what are overvalued, and what sectors are you favoring now?
Yeah, I mean, I think one of the benefits of being able to invest across the full spectrum of investing as real estate is there really are opportunities at any point in time across the world. In terms of what I like right now, take for example, in terms of equities, Australia and New Zealand public equities, so REITs are actually quite attractive. They're trading at 15 to 20% discounts to the underlying private equity values for the same type of real estate, and you're getting 8 to 9% yields. So you get paid to wait, and then you're getting a great long-term attractiveness as well. In terms of the U.S. market, I actually find that the U.S. public equity markets are relatively expensive. If you look at the overall yield for U.S. REITs, it's around 3.5% right now, and that's because you're paying up for the expectation of a recovery in fundamentals in that market. What I do like in the U.S. is the preferred share market. You're getting an 8% yield or coupon from preferred shares from the same REITs that are yielding 3.5%. You're higher up in the capital stack, lower risk, and that coupon is backed by the same quality cash flow stream as the underlying equities.
Now, this is less of a concern in the U.S., of course, but when you travel around the world to find these undervalued assets, there's two things that you cannot control. One is political risk, and the other is currency risk. I presume you're not buying forests in China, but you are traveling around the globe to find these assets. So what can you do to manage political risk and currency risk?
Sure. Well, effectively, you've got to price that into the valuation of the real estate that you're buying. So, for instance, let's take political risk. What we actually institute is a 13-variable risk model that looks at things like political risk, currency risk, transparency, the rule of law in the markets that we're investing in, other risks like the underlying real estate and the balance sheet of the companies themselves. And you've got to evaluate those risks and come up with a risk score that we then use to actually adjust the expected returns that we invest in that market so that we can compare them on an apples-to-apples basis. In terms of currency specifically and how we control that within the TIMBERCREEK Global Real Estate Fund is the two largest risks that we have, or exposure to currency, is in U.S. dollars and in the euro. And what we actually do is hedge those back. We use 3-month forward contracts. It's relatively cheap and efficient to hedge those back, so that cash flow stream gets denominated in Canadian dollars. Other exposures that we have, the two next largest would be the Australian dollar and New Zealand. Essentially, we've made the decision there to actually let those currencies flow. And the reason is we believe those currencies are relatively correlated to the Canadian dollar. They're resource-based, commodity-rich markets and have the same drivers as the Canadian dollar would, and we expect them to move relatively in tandem.
And those are not jurisdictions where you expect nationalization or any kind of major political risk to hurt you?
I certainly hope not, and we've got some other issues to worry about.
Now, Corrado, as we wrap things up, give investors an idea where the best opportunities are right now in real estate.
Sure. Well, I talked about New Zealand specifically, New Zealand retail. There's a company called Kiwi Income Trust, a very high current income stream, very stable cash flow, and with growth potential. They're levered to the overall growth in the emerging Asian market. In terms of another market that's levered to emerging emerging Asia is Singapore Industrial. So there's a company like Cache Logistics that is an industrial company. Again, you're getting in north of an 8% yield today and a very good growth profile as they continue to add new industrial warehouses to their portfolios. I also like mortgage REITs in the U.S. Again, I think we're familiar in this show. We've spoken about mortgage investment corps or Canadian mix here in the past. U.S. mortgage REITs are the U.S. version of that, and I think they're all being painted with the same negative brush. Obviously, through the financial crisis, a lot of these REITs ran into trouble, and you have to be able to sift through. If you look, for instance, yields on mortgage REITs today are in the 12 to 18% range. In some cases, you're getting an 18 for a reason. So you've really got to be able to identify the risks, the leverage. Some of these companies are very highly levered. Some of the companies have default risks on the revenue side. So if you can do proper due diligence and understand those risks, you can get paid handsomely.
Speaking of due diligence, how much of your due diligence, whether you're looking at something to get into or whether you're monitoring an investment once you have placed the trade, how much of that can happen at your desk with your Bloomberg terminal versus hopping on a plane and going and see what's happening with your feet on the ground?
Yeah. The one disadvantage, I say, of real estate as a portfolio manager is that it does have to happen on the ground. It's so focused on the local market. So you do have to travel a lot. You mentioned I've racked up a lot of miles, and I have, and that continues to be the case. You can't find good real estate sitting at your desk using Google Maps to try to find great real estate. You've got to get out there, kick the tires, but you've also got to have a team of analysts. So I've got analysts that are situated in the markets that we're investing in. They're kicking the tires every day, looking at the real estate, evaluating opportunities, and feeding that information back to me so that we can make good investment decisions.
All right, I think we'll wrap it up there. Thanks a lot for coming in, Corrado. That was fantastic. A lot of insight.
Great. Appreciate it.
And analysis from you. Thank you, David.
Thank you. Always a pleasure.
All right. We'll see you next week. That was Corrado Russo. He's the chairman of TIMBERCREEK Global Real Estate Fund. Our thanks to him. Thanks a lot for joining us. If you have any questions about alternative investments, you can email us at alternativeinvesting@bnn.ca. Thanks a lot for joining us, and we'll see you next week.